I'm Gareth Pronovost, and this is Entrepreneurship by the Numbers, where I help you to unlock the full potential of your business using data-driven metrics. Now, this video is dedicated to budgeting. Budgeting and forecasting for the small business is a very big topic this time of year. As it turns out, I'm recording in January of 2018. You, of course, are watching from the future. But this video is all about helping you understand how you can create a small business budget or forecast. So there are three major parts of your profit and loss statement that I'm going to be addressing in this video. The first one is revenue. This is top line on your P&L or profit and loss. And top line is driven by one equation: price times quantity. The price that you're charging for your service or product on average multiplied by the quantity that you expect to sell. That is going to determine the revenue that you will generate in a period. Next, we're going to look at two parts of costs. One of those, the first of those, is cost of goods sold. This is the part on the P&L that is subtracted first, because these are the costs that directly relate to the creation of the product or service that you provide. The second part are your other costs, and these are generally lumped into OPEX, operating expenses. These are the costs that don't have a direct relationship with the amount that you're selling or the creation of that product or service. So things like rent or marketing costs would be lumped into OPEX. Finance and accounting, always lumped into OPEX. So those are the three major parts we're going to take a look at today. Let's jump in and get started with a template that I put together. Okay, here we are inside this template for the P&L or profit and loss statement. First thing you'll notice, top line here, as I said, revenue. We've got revenue for 5 different products or services that you might offer, and then we're going to subtract out those cost of goods sold, and then we're going to subtract out all of those operating expenses. So this is where all of the data will be filled out once we have gone through the assumptions. So let's click on that assumptions tab and get going. For the sake of this example, I'm going to create a mobile dog washing service. So it's going to be called Mobile Dog Wash. 2018 is the year, and let's say we're at a 20% tax rate. Before I go any further, all of these like shaded yellow spaces are the fields that you can fill out. All of the other ones are formulas or don't need to be filled out. So what are the 3 different products or services that we might offer? Well, let's say we have a dog wash, and maybe we have a dog groom, and then maybe we have a bulk offer wash where we do 4 for the price of 5. Okay, so you'll see that when I filled these out in the yellow that they're filling out for all of the other categories as well. So, as I said, first equation for revenue: price times quantity. So we need to determine how many, the price that we charge for all of these things. Now you should know, as a business owner, what you charge for your services. So I'm going to be throwing in some make-believe numbers here. So those are our prices. And now going to our quantities, this is where things get tricky. How are we going to determine how much we're selling? Well, we can look at previous years and get an idea of where we're going to be selling. But everything, and this is important, everything that we sell, we need to have justification for. So if you would like to, you can take notes off to the side as to why you think you might sell more. So for example, if we only sold 700 washes last year and we think that we're going to sell 1,000 this year, we might leave a note for ourselves that says we are increasing our marketing expenses. And that would be a justification for why we expect to sell more. Because without a reason, we can't just expect the business to grow, right? Okay, now we're going to go into the cost of goods sold. Now these were the costs that are directly related to the creation of the product or service. Okay, so for this example, I'm going to make up these costs. And the things that we're going to add together, remember, we think about this as it shows you here on a per unit basis. So that means, how much does it cost us per wash? We have probably an hourly laborer that's working for us. We have the cost of gas to get to our our different clients. We have the cost of water, the cost of shampoo. Maybe we give a dog treat out at the end of the wash. So all of those things are wrapped up, and you can account for them on a per unit basis, so that you can say, hey, I do a wash, cost me 30 bucks, I charge 50. Okay, those are the costs of goods sold. Now the other part, these are the expenses that aren't related directly to each sale. So we've got things like marketing, or insurance, or depreciation. So those are the three I'm going to use for this example. And let's say I spend $300 on marketing over each month, so times 12. And maybe I've got a $1,500 a year insurance policy and $15,000 a year in depreciation. So again, remember, these justifications that you leave for yourself, they need to match what you're showing on your operating expenses. So if you're spending more in marketing, this better be more than you spent last year. Otherwise, this is a useless assumption here, right? So now that we have all our assumptions in for this example, we can click over to that output screen, the projected P&L, and we see here we've got all of our stuff working out. So this column right here, this is the column that is showing us the dollar amount. The column over here is what we call a common-sized income statement, and for common-sized income statements, we are dividing everything by the total revenue so that we can see every one of these numbers as a percent of total revenue. That is useful for analysis purposes, and I'll go into that in a future video. But for the purpose of this, we've got these three different revenue options here, and this is how much money we would project based on the price and quantity that we showed. Coming down to expenses, these are the direct costs of goods sold that are related to creating these sales. And then we've got our our operating expenses. And the way a P&L or profit and loss works, we sum up all of our revenue streams. We then sum our cost of goods sold and subtract that from the revenue, which gives us our gross profit. We then sum our operating expenses and subtract that from our gross profit, which gives us our operating profit, or EBIT. And from there, we deduct our taxes, and we are left with net income. All right, I hope that helped you get a head start on your budget. If you want to get a copy of this template, I will include a link in the description below that you can go to and download it for free. And if you enjoy this content, do click subscribe so that you know when new videos are released. And as always, best of luck as you continue to grow your empire.